Hey guys, what's going on? Dan Darrow here from Options and Play. So, I have talked about how much I love Straddles and Strangles, probably ad nauseum, right? And I'm sure you guys have heard me speak about those plenty of times. And I've actually uh, gone over in depth, really what I look for when I'm targeting those strategies, right? I'm sure you've also seen videos on that. Now, as much as I would like for all of them to play out perfectly, that's not obviously how it works, right? Trading's not a perfect science. Not everything will hit 100% of the time. So there are going to be trades that don't work, and this video is going to go over what my plan is when that doesn't happen, or when that happens, right? All right. So when we open a straddle or a strangle, it's because we're looking for a significant move in a stock, either up or down, right? That's pretty standard, and it really doesn't matter what direction it goes, right? Sometimes the stock just won't have a big move, and there could be a ton of different reasons why. Sometimes it's the volatility tightening up in the overall market, or maybe there's like the headline for the stock is mixed, right? So maybe like it's like a beat for the quarter and lower guidance, or maybe they beat on the bottom line, miss on the top line, right? So there could be any number of reasons why a stock might not have a big move. Um, and the problem is if you just bought a call or if you just bought a put and the stock doesn't have a big move, right? If it's just like flat, then you only lose on one or the other, right? So if you only bought a call and it's flat, then you only lose in the call. If you only bought a put and it doesn't move, then you only lose in the put. But when you buy a straddle or a strangle and it doesn't move, then you end up losing on the call and the put. So you end up losing on both sides, right? So the question is, what do you do with the straddle or strangle when that happens? Now, the way I approach the strategy, if the stock doesn't move, is either recovering net debit or salvaging remaining premium. So those are going to be like my two main focuses. It's either going to be recovering net debit, salvaging remaining premium. All right, and the rest of the video is going to talk about the difference between the two. Time until expiration is going to play a large role in determining which one. All right, and it's going to be kind of straightforward. So you'll see it's going to be, you know, like time until expiration plays a major role, and the reason why pretty straightforward. So more time for the position, right? Longer to expiration allows you to be more patient, and you can try to wait and see and claw back as much net debit as possible. If you have less time, then you don't have a wide window, and really your goal is just to try to get whatever premium back you can. All right. So I like to use what I call the 2 to 3 day rule, and a couple days after the earnings or the event or whatever it is, right? That allows for the news to work its way out there, and hopefully direction takes shape. So hopefully, like the stock starts to make a move, like a clean, clear, definitive move in one direction. If nothing materializes after those 2 to 3 days, then my focus is going to start shifting to recovering net debit or salvaging premium. All right. So the first of the two, recovering net debit. So like I said before, time is going to play a really big role in whether it's one or the other. All right. If there's multiple weeks or maybe even multiple months remaining, my goal is to wait till the stock has a big enough move either way to recover the original net debit of the trade. All right. So, or you could say the original net debit, or I'd say greater than like 80 to 90%. All right. So when that total net debit is recovered, or that 80 or 90%, then I'm going to make the decision whether to hold, roll, or cover. All right. That's the when you have multiple weeks, months, so when you have plenty of time, that's the plan. All right. So here's an example of what I mean by that. So this is more it's not necessarily a longer dated position, but it's one where it kind of plays into that 2 to 3 day rule and recovered net debit. All right. So Slack. All right. Work. Um, they were pricing in about 4.5 points going into earnings. Okay. Um, now, felt like because it was the first reports of public companies, software stocks, extremely volatile at the time. It just felt like it set up well for a big move. Options were pricing in 4.5 points. The strangle was the strangle that I was looking at was a 35 to 40 call spread and 25 put. So basically, 5 points either way, and that cost anywhere from like a dollar to $1.20. All right, and it was pricing at 4.5. Strangle was about 5 points, 5 points wide on either side. Now, as you can see from the initial first day, right, that was this big green, this big bar, heavy volume, a little bit of a bullish revert, bullish engulfing almost. Was that the stock ended up getting hit for 5 points, right? So it actually exceeded it exceeded what was priced in. The problem is that the low on that day was about 26. So the options, which were had about 2 weeks until expiration, they didn't move into the money because the stock only got down to 26. And when it rebounded, it obviously came nowhere near the 35 on the upside. So that day the stock closed say around 30, and both sides took a significant hit, right? So no, that's when like the 2 to 3 day rule plays in. So um, that's that's it's a kind of an ugly close. Both sides get hit, but you got to give it a little bit of time just to see if some sort of direction takes shape, right? So 2 to 3 days, right? The next day it dropped, right? And then the second day, so the third day after the event, so it's the third day total. So second day after like that initial reversal, the stock drops, breaks below 25, and we're able to recover a majority of the net debit of the original trade. All right. So that's kind of what I mean by net debit recovery and that 2 to 3 day rule. All right. Now, salvaging premium is going to be more focused on short-term contracts that have 2 weeks or less until expiration. And the thing is, with those types of contracts, they're going to be hit a lot harder on a muted move because almost all of the premium is in implied volatility, right? I mean, we've talked about implied volatility, intrinsic value, what makes up the pricing of a contract, right? So short-term options, high implied volatility, stock doesn't move, they're going to get hit very hard. The problem in these situations, or the problem with these situations is that it gives a much smaller chance for the straddle the Strangle to work because the trade window is so much smaller, right? So, you know, in the in some cases you have maybe multiple weeks, like 3, 4, 5 weeks, or even maybe a couple months. Then if it doesn't move immediately, it's annoying, but at the same time, there's still plenty of time for it to potentially move. But if you only have maybe like 1 week, then you really have just a very, 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 very tiny window. If it doesn't move immediately, then your chances of it working are much, much smaller, right? So these are kind of like the three really important factors that I like to consider when determining when to start taking premium off the table. All right. So um, this is on shorter term contracts and then that salvaging mode. Right. So it's the average daily trading range, number one. So how much does the stock move on a normal day or over a normal week? And is that enough to potentially put the contracts in play, right? So, if it's the stock moves an average of 1 point a day, you have 5 days left, and the options are 10 points out of the money, then that's it seems like it's a long shot, right? But if the stock moves 1 point a day, and you have 5 days left, and the contracts are only 2 points out of the money, well, that's a different story, right? Now, second second factor here. How does stock typically act post earnings or events? All right. So does it have a history of significant follow through? So maybe it has, over the past few quarters, it strung together multiple days up or multiple days down in a row after like the earnings came out or wherever the event is, right? Or some stocks have a history of maybe having really big reversals, right? So Apple, the last couple quarters, has had huge reversals right after reporting. And now the last factor is probably a little bit it's a little bit different than the previous two, because it's going to come down to the overall net debit remaining. All right. So if the amount of premium to salvage is only maybe like 5% or 10% of the original amount, then I sometimes like to view it more as a lotto idea. All right. So in the sense that the risk to reward perspective seems a little bit better just to hold and see if maybe there's like a long shot chance it comes back, because low probability, but at only 5% of the original net debit, like the potential risk at that point is also very small. So maybe it's a low probability that works, but it's also a low risk at only maybe 5% of the original net debit. All right. Okay, so this is going to be an example, kind of what I mean by salvage, and again, kind of fit into that 2 to 3 day rule. So, Dave and Buster's. This is a name that I felt set up well for volatility strategy. So a strangle in this case again. The stock was priced in about 4 points, and the trade was long 40 put and then a 48 to 55 call spread, and that the net debit of that was about say about $1.40 to $1.50, somewhere in that ballpark, right? And actually, as it worked out, it actually had a pretty significant gap. It was down over 6 points. Um, it was down over 6 points early, but it snapped back so fast we weren't able to cover the position before it traded back through 40. So the trade that was in the money was quickly out of the money, and it just sat in a very very tight range, and the options got hit pretty hard, right? So like these were short term, only these were only about a week and a half until expiration. Now, with Dave and Buster's, what you can see is that over like the previous couple months, it's really not a volatile stock. 1 point about the top of what it typically moves. So, I give it 2 to 3 days. Right after 2 to 3 days, you can even give it another fourth day. It really just was going nowhere. It was flatlining. Theta was taking a toll. It doesn't have a very volatile history, so it's as much as you want to hold to potentially think you want to hold thinking that it might make a move. 2 to 3 days played out, still hasn't found a direction. Doesn't have a history of large swings on a normal day-to-day basis. So it just made sense to take it off, take whatever premium was still left, and just move on. All right. So to summarize, when a stock doesn't move initially, right? So straddle or strangle, and it could be for whatever reason why it doesn't move initially. I like to give it 2 to 3 days, find direction, and then after that 2 to 3 day window, if it still hasn't picked a clear direction, then my focus is really going to shift to premium recovery or salvage mode. All right. Time remaining on the contracts, right? That's going to play a really, really big role in how I manage the position, whether I have plenty of time or I have a very, very small window, right? And then key factors to weigh when closing out the position are going to be average trading range, typical behavior after events, and the current net debit remaining of the overall straddle or the strangle. All right? So I hope this lesson on managing strangles and straddles was helpful. If you want more information about options trading, or if you're interested in trade ideas, be sure to follow up with the link in the video description for more information on options to play. All right. So I hope you all have a wonderful night, and best of luck with all of your trades. Talk to you soon.